This is one of my favorite investor interviews of the year. My guest today is Jeremy Evans from Era VC, a consumer-focused seed and Series A fund that invests across Australia, the UK and Europe, and the US. And that global vantage point gives Jeremy a really sharp perspective on something we don't talk about enough: how founder psychology, capital efficiency, and scale ambition change depending on where you're building. In this conversation, we get into the real differences between the US, Australia, UK, and European consumer founders, not just regulation, but mindset, how Era underwrites consumer businesses in smaller markets and why international expansion often isn't optional, the tension between building a great lifestyle business and building a venture scale outcome, why Era is comfortable with secondaries and minority liquidity, but cautious about misaligned founder incentives, lessons from Era portfolio companies like Seed in the US and Pillar Performance in Australia, what categories Era is most excited about heading into 26 with wellness optimization to measurement-driven health, why founder quality is still the true gate at Seed, and what separates a $20 million business and a $100 million one. And wait till the end, because Jeremy's most important advice for founders: don't burn optionality chasing the next fundraising milestone. Welcome to In the Money, an exploration of whether you can still make money in D2C and CPG. We talk to some of the most interesting $5 million to $50 million founders, operators, investors, and acquirers to ultimately answer the question, is D2C and CPG still a good business? Jeremy, Era is quite unique in that it's a consumer seed Series A firm that invests across Australia, UK, Europe, US. Maybe a good place to jump off from is, what differences are there between US consumer businesses, UK, Europe consumer businesses, and Australian consumer businesses that the audience might find interesting?
Yeah, sure. I think there's sort of some obvious differences there, like different regulations, retailers, consumer preferences, things like that. But the biggest thing, it's kind of obvious thing is market size. So I guess there's a limited, the way we think about it, like our sort of roots are in Australia, but there are a limited number of categories here where you can build a $100 million revenue business, which is sort of what we sort of try to underwrite to. So we need to underwrite international expansion. That's sort of one thing. Like if you're underwriting a US business, to be honest, you really don't need to think about international anytime soon in a lot of categories. That's changing, but it's historically true. An interesting one that people maybe don't reflect on as much is like the different founder personalities in each market, which I'm sure you've sort of come across. Like Australian founders generalizing a pretty modest in their sort of describing their backgrounds, even describing like the ambitions of their actual brand. They sort of sometimes even embarrassed to say things like they want to, be the number one in their category. Whereas if you sort of talk to a US founder, that's a very different conversation. I would say, there are some advantages building in Australia as well that we find. Like you can build in the early stages a lot cheaper here. The staff are, meaningfully cheaper. You can sort of test things out at a lower cost. Even though ultimately things that resonate here, you usually do find the customers are relatively similar, at least in markets like LA, maybe not the whole of the US.
What about UK and European consumer? Where do they fit along the spectrum of kind of, I suffer from tall poppy syndrome and I'm an Australian founder, and like I'm ready to take over the world and I'm an American founder?
I think the founder personality is much closer to Australia. The UK, I would say, is very similar. European, it's a broad brush. Like every country there is different. But I would say closer to Australia than US in that sense. And certainly in how they think about cash flow, like US founders are used to being able to raise lots of capital and things like that. So cash burn's less of an issue. Whereas the Australian and European founders will often try and set up their business so it's cash flow positive within like a year or two.
Yeah, I was chatting with the folks over at E-commerce Equation, which also maps both the US and Australia. And they had an interesting perspective, which was in Australia, they said kind of the median Shopify founder or consumer founder is very happy to start a business and run a small business. It could be like the local sandwich shop. Like, hey, if we got to 10 staff and a couple $1 million in revenue, like that's a good business that, can support our life. And whereas in the US, it's you have no, we're going to build a team, we're going to raise money, and we're going to go for growth. That's kind of the default view. I guess, like, as an investor, how do you align incentives, connect that psychology with something that you can get behind?
Yeah, I think like, and it's, it's important. There are lots of great businesses that don't raise venture capital. We are a venture capital fund, and that obviously comes with certain constraints. So, we ultimately need to return money to our investors. It's a relatively long time window, but it's still, say 5 to 10 years. We need to make certain returns, which obviously, are harder to achieve if a company doesn't want to grow. And you need to have a buyer at the end of it, like that's sort of wanting to buy that business. So like the way we approach it is a relatively frank conversation on those lines. And we're still very, like, every fund, like for every 100 or so deals we look at, we'll say no to 99 of them. But the type of founder that we are looking to back is aligned on those points, and so we find the ones that do that do want to grow really big businesses and sort of work with us.
Yeah. And again, sticking with that theme, kind of capital efficiency, I think in the last few years, we're now, 15, 16 years into digitally native consumer brands. People are getting more efficient, smarter, maybe have less need for capital. Like you said, there are great businesses that don't need to raise money. Putting that on one set, I have a European investor friend that said that he's had to get into the best deals via secondaries because they just don't need the money.
Yeah.
But I think much of the US mentality is still like you raise money to burn slash invest in growth. But like, do you have two different investing styles as a result of that?
Yeah, it's a good question. And so I think the secondaries is one endpoint. And we've done that before for one of our brands that, we really liked and was significantly cash flow positive. We don't love buying out. Like, one thing that concerns us a little bit is sort of giving significant cash to the founders as part of that. We're okay with them, like, de-stressing them. You don't want them like having like everything in on the company, but for obvious reasons, we want alignment with the founders and we want them to have skin in the game. But we're the best is like taking out other investors that are sort of looking for liquidity. We're very happy to do that if we love the business. So we don't really distinguish that much between it. You'll usually find that the secondaries will be at a discount to like a primary round. And there's sort of obvious reasons for that. But the other thing, we do have cases where, a brand is cash flow positive, could get by 100% without raising capital, but they're like, an extra million, 2 million, 3 million takes a little bit of pressure off them, lets them experiment a little bit, maybe like get rid of a debt facility, things like that. And in some cases, frankly, we've had other examples where they didn't need the cash, but sort of wanted a partner to help them, both to, help them improve the business along the way, also help them with the actual exit at the end. And then, so like number of reasons for it.
Yeah. Given that you're global by nature, but still a nascent firm, talk to me about leading versus co-leading versus waiting for a lead. Like, how do you guys think about that?
Yeah. So in Australia, for an Australian investment, we would pretty much always be lead. We know the market really well here. There frankly aren't a lot of consumer investors here. And even like when other people are like co-investing with us, they'd often sort of prefer us to lead as I guess the local expert. In US and international, we've done a mixture. I think we might have led half the deals and sort of participated in the other half, something like that. We don't really care, to be perfectly honest. Like, as long as we're investing with a like-minded fund, we obviously get the docs. If we don't like the documents, we sort of won't invest, or we'll at least try and improve them. And it can be helpful to have like other people that think like us along the journey as well. So we don't distinguish at all between them. It's a little bit easier at our fund size. We have a relatively flexible check size. Usually we are wanting co-investors anyway, particularly if it's a US company where it's raising a bit more capital. So yeah, like we don't need to sort of like, often the fund that wants to lead is partly doing that just to get a bigger allocation, right?
If you're running operations for an e-commerce brand, you know how hard it can be to keep fulfillment running smoothly as you grow. As your e-commerce brand expands into new markets and channels, logistics only gets more complex. So how do you make sure your fulfillment solution actually helps you scale? ShipBob is a modern fulfillment partner built for fast-scaling e-commerce businesses. Their hub-and-spoke network lets your business store inventory and ship from over 60 fulfillment centers across the US, the UK, Europe, Canada, and Australia, giving you flexibility to reach new customers and reduce cross-border complexity. Their dashboard shows real-time inventory across every location and channel, giving you a clear view of what's where. That kind of global network advantage helps streamline your operations, improve delivery experiences, and support expansion into new markets. If you oversee operations and want fulfillment to work for you, not against you, visit shipbob.com/podcast for a quote. That's shipbob.com/podcast. Are there a couple of investments, portcos that the audience might know that are fun stories to talk about?
The one that probably, a lot of people will be familiar with, certainly when we talk to like other companies about, it's one they look up to, is Seed. It's a probiotics business in the US. So we invested in that. I think the first round was 2017, 2018. And then we've done a couple of follow-on rounds since. That's just like an incredible business. Amazing founders, amazing products, frankly. And this sort of mixture of, which is quite rare, is very science-led business, spends a ton of money on R&D and making the very best products they can, but also being able to tell the story, like and actually being able to sell, frankly, like not just beautiful storytelling or anything, but actually convert. And so that's the sort of business that we got in, when revenue was, very low, and it's a sort of multi-$100 million revenue business at the moment, and also quite profitable. The other one that's a US business.
First, congrats. Well done. Let's just pause and see, let's learn a little bit more about science-backed, continuing to scale, doing it profitably, just why they're winning. And I guess maybe my first question is, back in kind of 2017, science-backed wellness was a little bit more novel. I think almost everything that's coming out today is now science-backed wellness. So how are they continuing to win in market? And what other attributes have made Seed so successful?
Yeah, I think, you're right. Like back then, I would say both less science-led brands, and although probiotics were obviously a category that was growing, it still probably hadn't had mass adoption, particularly in the US. We had seen that, by the way, in Australia a little bit earlier, so it wasn't a surprise that gut would take off like that to us. I do think people look, there is, in terms of number of competitors, defensibility, all that sort of stuff. It is true that in consumer, you can sort of copy the formulations of a lot of products. C does have some secret sauce that is a little harder to copy, but by and large, a successful brand, copycats appear, and their formulations are often very similar. But I think it is very hard to copy the actual branding of it. Like if you're the second person and all you do is copy the messaging, that really doesn't resonate with customers. And you've seen this over and over again. You might carve out a small niche of super budget conscious customers at a lower price point or something like that, but you're starting behind because your price point has to be a lot lower if you're going to go down that strategy. You've got less to invest in R&D, marketing, and you just don't have the same sort of cut through with consumers. So although in theory you sort of go, how defensible is this? The first mover advantage tends to be pretty strong. And I don't think it's unique to consumer either. If you look at, we kind of get pushback from some people that are used to investing in software or whatever, talking about what is your moat? And if you really dig down to a lot of software businesses, and not all of them, but a lot of them, the actual physical product is pretty easy to copy. I mean, it's easier now with AI. But what they've built is like this huge customer base, the cash flow from that customer base to support future growth, and just like that community is you can't replicate a community, and that's sort of what I think people miss a little bit is it's ultimately brand in both those instances.
I don't know if you can talk about this, but when I researched Seed, it seems like they've only more recently gone into retail distribution. And I know over the last 5 years, every consumer investor has said, hey, if it's not omni-channel, we're not interested. Everything needs to be omni-channel. It sounds like Seed succeeded for a long time at significant scale, profitably online only. I'm sure they would have gotten multiple buy interests to go into like maybe just talk about how to think about whether you should stay online if it's going well.
Yeah, I think there's sort of a couple of things there. Like one thing is, the acquirers of brands, largely the big sort of strategic companies that everyone knows, Unilever, Procter Gamble, etc. These guys sort of bought a lot of DTC brands 10 years ago that have gone very poorly. Like the obvious one, I won't name names, but everyone sort of knows the ones I'm talking about. And there haven't been that many success stories, frankly, where they've bought an online-only brand and scaled it and sort of made their acquisition worthwhile. So, like the strategics that you're exiting to, ultimately, for better or worse, they have decided that what they want to see is some level of retail success. You don't have to be conquering the world, but like proof that it works in retail. And then sort of the playbook to some extent is to scale that into, more stores, potentially globally, and sort of turbocharge that with their own distribution and sort of selling abilities. So that's like one reason. I think the second reason, which like everyone's probably also aware of, is just the cost of acquisition has gone up a lot over the lot. Like, there used to be people used to talk about the sort of arbitrage of DTC brands, which sort of probably switched. And now it's got to the point where maybe the cost of acquisition is effectively less than the margin you pay to the retailer. And so I think it's really like those, plus there is just still a large percentage. Like we talk about online, depends on the category, but let's say it's somewhere between 10 and 50% of the total market. Like, why would you leave that remaining, 50 to 90% there? Like, you should be in store. And there's a little bit of the issue that a lot of brands run into when they're going into retail is they're used to measuring really precise metrics like CAC, LTV, all these things that you can basically calculate perfectly with online data. As soon as you go into retail, like you'll get some measures from the retailer, but that all sort of goes out the window, and the exact metrics that you have, you don't know. You don't know the lifetime value of someone shopping at Walmart. You don't know what the repeat versus new revenue is. And so it's sort of, it becomes a lot more complicated. But if you're willing to deal with that, the kind of prize, the revenue that you can get, the profitability is sort of there for the taking, but it's a different playbook. It really is.
So it sounds like Seed staying online only is very much the exception to the rule.
No, so to be clear, sorry, I didn't mean to imply that. There are 100% brands that do it well, and most of our portfolio are omni-channel. So I should have probably, like, we have liked omni-channel from the start. The history going right back for our sort of our founder, like some of our founding team is part of Swiss Vitamins, which was a multi-billion-dollar sort of exit, and that was effectively 100% retail. And so, well aware of that channel. But to clarify on Seed, so it basically launched into Target, you're right, 2 or 3 years ago after a long period of doing really well online. And they've done really well. You just have to be, you have to play the game right. You need to understand what stores you're going to be in. You still need to support it with marketing spend. You can't just expect it to fly off the shelves. It no longer is like some people sort of put their brand in Target and expect Target to sell it. But that doesn't happen anymore. You still need to have the advertising dollars. And if it doesn't fly off, or if it doesn't sell enough to meet the retailer's targets, you'll be off shelf.
Why do we love Numeral? Well, here's the good, the bad, the ugly. The good is that over 2,000 e-commerce store owners just like you use them for sales tax compliance, including brands like Grunz, Graza, Ridge, and 8 Sleep. The bad is that none of us got into this to spend a ton of time on sales tax and admin, which is why Numeral is able to help you in 5 minutes or less get full coverage, deal with registrations, ongoing filings, and compliance. It all just happens in the background. And the ugly is that not a lot of store owners know that sales tax is actually personally guaranteed. Said another way, that the states could end up coming after you personally if you're not on top of it. Even being a modest $5 million store owner, you could have nexus in 20 to 30 states. Again, Numeral helps you stay compliant, and they even guarantee their work. That's why we love them. Go check them out at numeral.com. Jeremy, you were going to maybe give us another one or two other portfolio and learnings.
Yeah, I thought maybe just contrast it with an Australian company that's done really well, a slightly slower slightly slower journey than Seed, which probably gives you a contrast. It's called Pillar Performance. So it was a brand started by an ex New South Wales rugby player called Damien Fitzpatrick, and he went through. He was the first player to come back from 3 knee reconstructions effectively. And so went through a journey of, high performance supplements effectively. So he had a really, and this is what we really love in founders, is when they're really invested in the thing that they're trying to sell. Like he was selling the formulations that he sort of like worked up and used for himself initially. And just the way they started out really targeting that premium segment of like performance athletes. And then you get these performance athletes using it, and then it sort of works its way to the weekend warrior style, and then sort of works its way downwards. And they've just been really considered. They were actually started online retail effectively from day one. They built it through specialty running and cycling stores rather than sort of going mass. And just created this like incredible community, like to the extent that most cyclists and runners in Australia and increasingly globally, like they know Pillar. It's even if they don't take it, it's everywhere. They just like they know their product inside out and know their customer, and they go and sell. A lot of brands we find, they sort of like there's a little bit of not wanting to like get their hands dirty, if that makes sense. Like they don't want to go to the trade shows, go to these like, go and visit the retailers, visit their customers. Whereas like Pillar's done that, and it's been a grind. Like they've built it. They've like revenue is well into the double digits, but they've maintained profitability almost the whole way. And they've also got like a relatively material amount of international revenue while building out of Australia.
Are Seed and Pillar both subscription?
Seed when you check out effectively only offers subscription. You can obviously cancel it, but it's essentially subscription only. Pillar is a combination. What you usually find is like if you offer both, you get kind of 25% or so of people subscribe, depending on the offer that you put. That could be up to 50%. It depends on the discount and stuff you offer.
When I looked at Pillar in the past, there's some big name endorsers. Yeah, how do you think about that as an investor? I don't know if you're comfortable sharing, like how you get names like that on board. Is it cash, equity? Without going into too much detail, but yeah, maybe as an investor, do you like these heavily endorsed brands? Have you guys invested in, I think you actually have invested in another kind of celebrity kind of first brand. You've obviously invested in non-celebrity, like, yeah, just that matrix.
Yeah, it's done the right well. It's really powerful. I mean, the ambassador or celebrity really has to be authentic to what you're selling. That's the number one thing. And they kind of like, you want them to really love the product, like to the extent that like you'll always have a contract that says they have to do this and that. But the ones that really work is when that ambassador loves the product so much, they're just going above and beyond that. And whenever we see them doing exactly what the contract says, it's usually a sign that it might not work out. That's kind of one thing. It sort of translates as well. Like particularly at the early stages of a company, like Pillar wouldn't have been able to afford probably what you're thinking those people might have been paid. But again, there's a little bit of, selling from Damien, like getting these people on board, a little bit of the brand and the celebrity really resonating with each other. So I just think like it can work, but if you go out and pay the market rate that they're getting from Unilever, like it's very unlikely for that to be viable in a lot of cases. The other thing is like if you just got to be really careful of becoming too attached to one person. It can lead to some issues in terms of even exiting the brand, right? Like the acquirers are going to rightly ask, like, what happens in 5 years if this person goes off contract?
Subscription, wellness. Are there other things that Era is looking for? Maybe let's talk about 2026. What's the thing that you want to be, landing on your desk next week?
Yeah, so just to clarify, like subscription revenue is good in the sense that it's usually high. The recurring rate's usually relatively high, but like whether it's subscription or not doesn't really matter. But certainly omni-channel does. In terms of what we're interested in, like wellness is a category, but within that, it's really like people taking charge of their health more effectively. And some of this has come from GLP-1 and things like that. Like there's a whole class of people that, until you feel like you suddenly, so say you lose a lot of weight and you're suddenly feeling better that way. Now taking protein, taking creatine, taking collagen as an example, and sort of optimizing your health even further. We see a lot of that. Like you can really see it in the data. Even in protein, like it's pretty incredible. So that's a big trend. The other thing that we are super interested in, we haven't quite found the right one, but is just like the feedback loop between measurement and then improving, measuring your blood effectively and improving those results. And there's a function in the US. There's Rhythm now, which is an Aussie in the US. They're sort of examples of that trend, but yeah, they're the sort of categories we're doing.
AI. Everyone's talking about it, and you're worried you're getting left behind. Meet RichPanel, an AI-first customer support platform that's built for one thing: making support faster, smarter, and cheaper for e-commerce brands. Something you can actually feel smarter about using. RichPanel combines a unified inbox across email, chat, and socials, a customizable self-service portal that customers actually use, and Sidekick AI, which learns from your past tickets to suggest on-brand replies. Does it actually work? Well, with RichPanel's guarantee, you get guaranteed 30% cost savings when you switch from Zendesk or Gorgeous, 30% automation to reduce your ticket volume, and a no-risk guarantee that if RichPanel doesn't deliver those results in 60 days, you get a full refund. That's why top brands like Ridge Wallet, Jones Road Beauty, and Pella Cases are already using RichPanel to save hundreds of thousands in support costs. Time to start letting AI work for you. Head to richpanel.com and start your free trial today. Real savings, real automation, and real AI that actually works. Is there stuff outside of, other categories outside of wellness that you're kind of turning over rocks, researching, developing a thesis around?
We've long kind of categorized it as health, wellness, and beauty, and so we still look at what we call beauty pretty broadly, but within that, sort of like the intersection of beauty and wellness is more interesting. So like a skincare product that like potentially delivers you benefits beyond just like looking a little better or just moisturizing your skin. We've got a brand in our portfolio called Iota Beauty that's sort of leading with that messaging and is doing really well. We have the flexibility to do other categories within consumer, and we look at them regularly. Like food and beverage is the biggest one. We haven't yet done an investment in food and beverage, but we will. It's just a very different structure, right? Like the price points are very different. The margin you're playing with is a lot smaller. The distributor's very different. And that category, as an example, is very hard to do in Australia. You really do have to do it in a bigger market. But yeah, that's one where we're we will spend probably 2 years on it before we do a deal.
At the seed stage, are you kind of more quantitatively underwriting the business and saying, look, this velocity is flying, this retention cohorts are amazing? Is it more, hey, this is a level 12 founder, they're willing to grind, they have a vision, but they're also super dialed? Is it more, hey, this is kind of category and thesis driven, this is kind of protein in 2022? Like, what gets you most excited?
You have to have a lot of those things together, but the thing that there's a lot more, I guess, companies in interesting categories that we like, as an example, than there are sort of founders that we think can build like $100 million revenue business. It really does take a certain type of founding team, a certain type of founder to do that. And, look, it's not, obviously we make a lot of mistakes in terms of interpreting that, but it's an imperfect science. But the types of founders that we've found that sort of succeed in doing that, they tend to be just relentless. They know everything about the company. They know, if you ask them a question, like, they can almost always answer it. And if they don't, they have a great answer very soon afterwards. They learn what they don't know very quickly. And they're just across every detail. And yeah, it's sort of, you do get a sense for that. And we spend a lot of time with them. Of course, like, they still need to be in the category that we're interested in, a good market. But certainly the one that is the gate, I guess, is the founder at the seed stage.
Yeah.
We can tweak a lot of things. Like, if the price point's not quite right or whatever, like, that's all tweakable. You obviously can't really change out the founding team.
Yeah. Jeremy, a couple of quick fire questions. Is there a tactic, channel, piece of tech that's working especially well for kind of portcos right now?
You probably heard a little bit of this, but the one that by far is having the biggest impact on Meta is just volume of content. So, from very big brands that are getting a lot of noise right now to small ones, like, we for instance, it's like a brand we know quite well, like, they've gone from 100 ads a month to 1,000. Others are much higher, and
Yeah.
that actually, just that alone, that was sort of hitting a roadblock, and that's sort of broken them through the next hurdle of growth. We see that pretty regularly now. That's quite hard to do, but is a bit easier, obviously, with AI tools and things like that. And what that effectively means is you throw 1,000 ads at Meta, their algorithm is essentially working out which ones are resonating the most, and you will only end up investing between, say, 5 to 10% of those ads. But you just have to throw a lot of content at the machine to sort of, it's just changing. It just changes all the time. And the type of content that worked 6 months ago doesn't work now because it's been done too often, and so on. So it's really like a daily, weekly kind of thing. And yeah, anyone that's too stagnant on that will quickly sort of tail off. That's the biggest thing right now.
What's your biggest piece of advice for founders, whether in portfolio or just new ones that you're meeting for 2026 in terms of capital planning?
Big one right now is, and this has been the case for probably the last 2-3 years. I mean, consumer market became a lot more challenging, around 2022, 23. And we see there's a lot of founders out there that, they're doing, say, low single digit million of revenue. And they'll meet a big fund that that sort of tells them they only write $3, $5 million, $10 million checks, whatever the number is. So they'll only do the Series A or B. But when you're doing 10 million, 15, 20 million revenue, you sort of come and talk to us, and like, something will happen. And like, there's nothing untoward in those statements. Like, these funds are just doing their job 100%. And usually, by the way, they are not over-promising, but founders have a way of interpreting things to make them what you want them to be. But what that often leads to is sort of founders effectively thinking like, oh, I just got to get to this number, And then when I get to it, I'll have all this cash. And so they throw everything at getting to the number. They lose sight a little bit of their metrics, like cash burns too high, etc. And they obviously lose the optionality of staying alive because they then kind of need this capital to stay alive. And then the funding doesn't happen. And maybe partly it's because they probably lost sight of some of those metrics. Like suddenly the CAC doesn't look great or whatever. And partly it's just like, funds are very picky. Like it still has to go through their investment. There's still so much work to do. Like that one meeting or two meetings that you've had, it's still like a 1 in 100 shot at one particular fund. So I just think it's being like really careful around cash, making sure that you're sort of, you're alive even if you miss your fundraising deadlines, and starting your fundraising as early as possible, like well in advance of some companies still out there trying to raise capital with like 3 months of headroom left, like at least 6 months, but I would be encouraging even more than that.
Yeah, what a great perspective. I recently had an investor, Connor Ryan from Bridge in the US on, and he said something so simple that just never thought about it this way, but I found it really poignant. He said that revenue growth isn't the indicator of product market fit, unit economics are.
Yeah.
I heard what you just said as a kind of another way of interpreting that, of like maybe certain consumer businesses are really great $20 million businesses and maybe they aren't very good $100 million businesses. But unit economics is maybe a bigger tell. Hey, is there enough customer demand on Meta? Is there enough retention through the product and customer than revenue velocity, which you can kind of force through spend? But yeah, not to kind of lose sight of that, just to get to the next milestone.
Yeah.
Jeremy, as we wrap, is there anything that you're seeking from listeners, types of brands you want to see, operators, collaborators?
Yeah, look, obviously always looking for great brands to invest in, but also great people. So if you have an absolute top tier person that you think could be a great founder, or you are one yourself, like I'd love to hear from you. We would also, like all of our portfolio companies are essentially always hiring the right sort of person. And yeah, so anyone, particularly, the number one across all of our business right now is marketing talent, as you'd probably expect. And number two is probably, financial resource. So yeah, we kind of run little like recruitment processes for our firms to help them out on certain roles. So yeah, that would be great.
Awesome. Jeremy, thanks so much for coming on, and look forward to next time.
Thanks, man. Great to see you.